17% wiped out in a single day. No warning, no breaking headline, no emergency announcement. Silver didn't just fall, it was slammed. One moment it was trading comfortably, the next it had erased nearly 70,000 per kilo. And that's the part everyone is struggling to explain, because nothing obvious happened. No war broke out, no bank failed, no pandemic news, no policy shock, absolute silence on the wires. This was not a normal sell-off. This was not profit booking by small investors. This was something far more deliberate. Silver was trading near euphoric levels. Momentum was unstoppable. In just weeks, it had delivered gains people wait a lifetime to see. Analysts were throwing out wild targets. Social media was flooded with screenshots, celebrations, victory laps. Everyone believed the breakout was real and permanent. It felt like silver had finally broken free. Then the market opened. Within minutes, enormous sell orders hit the system. Not thousands of ounces, millions. Institutional-sized blocks dumped all at once. Prices didn't slide, they collapsed. Key levels that were supposed to hold for months disappeared in seconds. Every support cracked. Stop losses detonated. Margin calls began firing automatically. Traders weren't choosing to sell. The system was selling for them. By the end of the day, silver had lost nearly a fifth of its value. Gold followed. Hundreds of billions in paper value vanished in hours. And here's the most unsettling part. When people asked why, the answer was nothing. Just a correction. Markets overheated. Healthy pullback. That's the story being sold. But it doesn't survive even 5 minutes of scrutiny, because crashes like this don't happen randomly. They have fingerprints. To understand what really happened, you have to rewind the clock. Look not at the crash itself, but at the weeks leading up to it, because the damage wasn't done in one day, it was engineered over time. Weeks earlier, while silver was climbing and optimism was growing, the exchange that controls silver futures quietly made its first move. Margin requirements were increased, barely noticed, no outrage. The market kept rising. Then it happened again. And again. Each time the cost of holding a leveraged position went up, suddenly, without warning, and just days before the crash, the final adjustment landed. A structural change, margins recalculated as percentages instead of fixed amounts. Overnight, holding silver became dramatically more expensive. Here's what that means in plain terms. Most futures traders don't pay the full value of silver up front. They post a fraction, margin, and control a much larger position. That leverage magnifies gains, but it also magnifies vulnerability. When margin requirements rise, traders must add cash immediately. Not next week, not eventually, immediately. And if they can't, their positions are forcibly liquidated. The system doesn't ask. It doesn't care about your conviction. It sells. Now imagine that happening to thousands of traders at the same time, all forced to sell into the same falling market. That's not a correction. That's a cascade. This is why prices didn't drift lower. They fell off a cliff. And if this feels familiar, it should, because this exact sequence has happened before, more than once. Same metal, same mechanism, same outcome. In the late 1970s, silver exploded higher. Ordinary people were finally winning. Confidence in paper money was cracking. The response? Overnight rule changes, leverage banned. Interest rates hiked aggressively. Silver collapsed nearly 80%. In 2011, history repeated. Silver surged again. Retail participation surged. Banks with massive short exposure were under pressure. What happened next? Margin requirements were raised repeatedly in rapid succession. 5 times in 9 days. Silver crashed by half and stayed suppressed for over a decade. And now, here we are again. Silver rallies hard. Momentum builds. Confidence grows. And suddenly, margin hikes, forced liquidations, a violent collapse. Once is coincidence. Twice raises questions. 3 times is a pattern. So ask yourself this. Why does this keep happening to silver? Why does the rulebook change every time it gains too much attention? Why is this metal treated differently? The answer has nothing to do with silver jewelry or industrial demand alone. It has everything to do with what silver represents. Silver is money, real money, tangible, finite, honest. And that makes it dangerous to a system built on unlimited paper claims. The modern financial system depends on trust in fiat currency, especially the dollar. The dollar's power doesn't come from gold backing or discipline. It comes from necessity. Global trade, energy markets, reserves. Everyone needs dollars, so everyone accepts them. But that dominance is eroding. Central banks are quietly reducing dollar exposure. Treasury holdings are being trimmed. Gold reserves are being built at the fastest pace in decades. For the first time in modern history, physical metal is overtaking government debt as a trusted reserve asset. That's not a small shift. That's a warning signal. At the same time, the physical metal supply chain is tightening. Silver isn't just an investment metal, it's a critical industrial input. Solar panels, electric vehicles, electronics, defense systems, demand keeps rising, supply doesn't, and yet the paper market treats silver like it's infinite. Contracts are created with keystrokes. Leverage multiplies claims far beyond available metal. As long as confidence holds, it works. When pressure builds, something has to give. Friday was that moment. This wasn't about profit booking. This wasn't panic selling by small investors. This was the release valve opening, forced selling triggered by rule changes, a mechanism that has been used before, deployed again. And the real story doesn't end with the price crash, because while the paper price was collapsing, something very different was happening elsewhere. But to understand that, and to answer the real question, sell or hold, you need to see what's happening in the physical market, who is buying, and why this crash may not mean what it looks like on the surface. While paper prices were collapsing on screens, the physical market told a completely different story. This is the part most people never see because it doesn't flash across trading apps or scroll across television tickers, but it's the only part that actually matters. Before the crash, even with silver trading at elevated levels, physical supply was already under strain. Mints were struggling to keep up. Delivery delays were growing. Premiums were rising. In some regions, retail products were simply unavailable. That alone should have raised alarms. When price is high but supply is tight, something is broken. After the crash, that disconnect widened. The paper price said silver had fallen hard, but try buying physical metal. Call a dealer, check availability, look at premiums. In many cases, silver didn't get cheaper at all. In some places, it became harder to find. That's because paper silver and physical silver are two completely different markets pretending to be one. Paper silver is a promise, a contract, a claim that can be created instantly and destroyed instantly. It can be margin called, it can be liquidated, it can be crushed by rule changes. Physical silver cannot. You cannot margin call a bar sitting in a vault. You cannot change the rules overnight and force someone to sell metal they already own outright. That's the difference. And while Western markets were liquidating paper contracts, something else was happening quietly. Physical silver was moving east. Vaults were being drained, not sold, removed, taken for delivery, loaded and transported. This didn't start on crash day. It's been happening for months. The countries doing this aren't guessing. They're positioning. Silver has been in a structural supply deficit for years. Every year, more silver is consumed than mined. Solar energy alone absorbs massive quantities. Add electric vehicles, electronics, medical equipment, and defense applications, and demand keeps climbing. Meanwhile, mine output struggles. Grades are falling. New discoveries are rare. Bringing a new mine online takes close to a decade. None of that changed because of a one-day crash. The fundamentals didn't break, the paper structure did, and this is where perspective matters. Every major silver collapse in modern history looked terrifying in the moment. In 1980, people thought silver was finished. In 2011, many gave up entirely. Each time, it took patience, years, but each time silver eventually reclaimed its value and pushed higher. Suppression can delay reality. It cannot erase it. Now look at the global backdrop. Trust in paper assets is thinning. Government debt keeps growing. Currencies are being printed faster than productivity. At the same time, nations are stockpiling real resources, metals, energy, supply chains. Silver sits at the intersection of all of this. It is both money and an industrial necessity. That dual role makes it uniquely powerful and uniquely inconvenient. So when silver rises too quickly, it exposes weaknesses. It raises uncomfortable questions about currency value, about inflation, about whether the system is as stable as advertised. That's why the response is always forceful. The crash wasn't random. It was a message, a reminder of who controls the paper market. But messages cut both ways because the very fact that silver must be controlled so aggressively tells you it still matters. If it were irrelevant, it would be ignored. If it posed no threat, it would be left alone. So is this profit booking or is it time to hold? That depends on your time horizon and your understanding of what you own. If you were trading leverage, the system just showed you the risk. If you were speculating on short-term price moves, volatility is the price of entry. But if you hold physical silver as protection, as a long-term store of value in a world drowning in debt and paper claims, the story didn't change. It clarified. The crash stripped away excess leverage. It exposed fragility. It reminded everyone that paper prices are not the same as real value. No one can tell you where the exact bottom is. Silver could fall further. It could rebound quickly. Anyone claiming certainty is guessing. But history offers context. Every time silver has been attacked this aggressively, it was because it was becoming too important to ignore. You don't fight this hard against something meaningless. What happened was not a judgment on silver's worth. It was a demonstration of power by the paper system. And those demonstrations tend to happen right before long periods of repricing. They call it volatility, they call it risk management, they call it a healthy correction. But if you've seen the pattern before, you know what it really is: a cycle repeating, pressure building, rules changing, and eventually reality asserting itself again. Silver didn't fail on that day. The illusion of control cracked. What you do with that understanding is your choice.